Joining us to get across the market open now is Jimmy Jang from Macro. Jimmy, great to have you back on Ausbiz. Thanks for joining us as we'll begin on Wall Street. A very positive session to the point, in fact. Tech stocks rallying, the Nasdaq eclipsing a milestone essentially.
Morning, Andrew. Absolutely, and the CPI data obviously met the expectation of by the Wall Street, and reinforcing that belief that inflation is now under control, and which obviously, like you said, fueled the optimism in the tech sector. We saw Nvidia rise 3.4% alongside that record highs in the Nasdaq index, and also the market is pricing in at that 25 basis point rate cut during the Fed's meeting next week, obviously also pushing that sentiment further. So the US CPI increased about 0.3% in November, and it ticked up from about 0.2% in each of the previous 4 months. And annually, the inflation obviously accelerated to just slightly higher than October's pace, which is 2.7% at the moment. So both were largely in line with the forecast. Along with the CPI data, we saw that Treasury yields in the US also rose across all tenors. And the 2-year yield, which was interesting, which reflects obviously the short-term rate expectation, rose slightly to about 4.159%, while the 10 and 30-year yields also increased as well. So while that bond yields kind of remain elevated, market pricing strongly supports a December rate cut, and we saw the CME's Fed Watch tool also indicating close to 95% probability of the Fed cutting the rate by 25 basis points next week. So the Fed's current focus on balancing rate cuts with maintaining that financial stability will obviously dictate the pace of the reductions. And we're seeing the new government coming in the US, but with the Trump administration, and one of the concerns are that the inflationary environment coming back in, especially with that corporate tax cuts and that universal tariffs being imposed on all the US imports. So it will be interesting to see how that will play out with the Fed's target over the next 6 months. But there's also market sentiment is something we need to be very wary as well. So following with that, the rally that we've seen in the Nasdaq and also with Nvidia as well, that alongside with the Bitcoins also rallying, it's going to obviously lift that global sentiments. And in Australia, we saw the ASX futures are up around 41 points, with obviously sectors like resources and industrials also looking very strong, obviously supported by the stable commodity prices like gold at $2,700 per ounce, and obviously oil recovering above $73 a barrel as well. So in this kind of current market, we definitely like the industrial sector right now, especially with these commodity prices obviously recovering. And there's a lot of companies out there, especially in the industrial sector, that's been hit quite hard over the last, let's say, 3 to 6 months, just purely because of the commodity prices. So it'll be interesting to see how this will play out very soon.
All right, just before we get into that, industrials in particular, in terms of resources though, Jimmy is saying those commodity prices obviously rising, and a lot of that was sparked by what we're likely to see out of China. In fact, the Central Economic Work Committee conference is underway at the moment in China. What are the expectations there, and more broadly, what you're seeing in the resources sector as a result?
I mean, one of the concerns are that, with these new kind of, so obviously with China's initiatives to recover the economy, it's just timing. When will that actually be turned around for these resources sectors? And, it's not looking that positive, especially with Trump's obviously imposing close to about 60% tariff against China. Whether that's going to be coming into effect, also it's uncertainties as well. Obviously, Australian miners are very dependent on China, especially with iron ore. And in that kind of scenario, if that recovery isn't coming as quickly as the market has hoped, that's going to be very struggling for the resource sectors, not in terms of their forecast, but just struggling to keep their investors in place, to just calming them down, saying that the outlook is a lot more brighter than the short-term tailwind. So it will be very interesting to see how that will play out. But again, in this kind of environment where there's so many uncertainties, like we've got the big two wars are still ongoing right now, and we've got the new government coming into the US. If you are already in these resources sectors, it's probably a good time to still hold, because the outlook is still looking strong. But it's very difficult to kind of recommend to buy new resources sectors right now in this kind of volatility. So that's why we probably prefer the industrial, because there's a lot more different sectors, different businesses that these industrial sector companies are exposed to. Rather, it's not so sensitive to China.
Are you looking for more exposure to gold at the moment or not?
Gold, yeah, definitely. We increased our gold exposure to about 6% over the last week from 3%. So we kind of doubled our exposure there. We've done it through a position called PM Gold. Now, gold is, again, it's more of a, like the hedging exposures that we have in the other portfolio, but, which we can't go in too much in detail for the short space of time today. But, with the US dollars, obviously, it's just continuously getting stronger. The gold definitely is taking a good place. And right now, a lot of the different countries, like China, mainly obviously the biggest country right now, buying gold is obviously pushing the prices of gold at the moment. So, with the war still ongoing and the investors are still putting that confidence in gold is obviously a good sign. But, whether the gold prices will be, continuously surging right now is a really big question, even for us at the moment. And it's more about like an investor should be looking at gold as more of like a hedging exposure to their equities in case obviously we see a bit of a more further tailwind in the equities and also in the war zone in the Middle East and in Ukraine. But whether that's going to be a big exposure that we recommend clients to take, absolutely not.
Now, Jimmy, you mentioned there the focus on the industrial sector for you. What stocks in particular would you be looking at the moment?
There are definitely good names out there. I mean, I've spoken about Brickworks for a while on Ausbiz as well, but in particular for today, we looked at two companies. So we got the SRG Global, which showing some exceptional performance. Now, their financial year 25 contract wins that exceeding expectation, coupled with its growing EBIT margins and recurring revenue base. On the 19th of November, the SRG announced that they secured $700 million of contracts across Australia and New Zealand. And the TOM contract secured with repeat clients in the water, dairy, and the resource sectors, and the specialist services contract secured in the transport and health sectors as well. So this is obviously underpinned by that strong growth profile and an 80% recurring earnings base, which is largely in line with SRG's Global's long-term strategy. So we definitely like that name at the moment. And Austal is the second one, and it's also Australia's leading defense exporter with a record order book around close to $12.7 billion. And, its role in that renewal of that Royal Australian Navy fleet position for sustainable growth. And obviously we anticipate significant earnings accelerating from financial year 25 onwards. So Austal and SRG Global is probably our preferred name right now that we picked. But in terms of that, there are definitely better names out there, in the industrial sector. And what we like to definitely take in part is making sure that these other industrial sectors don't take more than, let's say, 15% of our portfolio. But right now it is across Brickwork, Austal and SRG Global at the moment.